Welcome to my channel. More knowledge, more wisdom. Myself, Balaganesan Rajagopal. More knowledge, more wisdom. Share whatever the knowledge you receive every day to everyone. We are in the last quarter of the financial year, so I thought a video about tax saving and investment would be more useful for the salaried people in India. As a salaried employee in India, everyone should understand their CTC, payslip, tax slab, and salary breakup line items. This is the first step to save on their taxes. Let us see about in detail. Let us see about the tax slab for age group less than 60, which covers the major tax paying population in India. This is a slab shared by the central government to the taxable population. This video is mainly prepared for the benefit of the salaried people, where to invest to save their taxes. Let us go into the video. How to save tax? This is the primary question asked by each and every Indian who are all paying taxes. Everyone earning income in India is liable to pay income tax. The income tax department has fixed five heads under which taxable income is calculated. These are salary, house property, capital gains, business and profession, and other income sources. How to calculate tax and taxable income on salary? This is one of the important and first step that each and every salaried person has to take. First, add your income minus your exemptions and HRA. That will give the taxable income. As per slab, calculate your taxable amount. Let us see about the tax exemptions. Deduction on sections 80C, 80CCC, 80CCD, and 80D. These are very important sections. Please don't skip it. Let us first see about the section 80C. 80C allows deduction for investment made in PPF, EPF, LIC premium, equity linked savings scheme, principal amount payment towards home loan, stamp duty and registration charges for purchase of property. Suganya Samriddhi Yojana SSY, National Saving Certificate NSC, Senior Citizen Savings Scheme SCSS, ULIP, tax saving FD for 5 years, infrastructure bonds, etc. All these will come under 80C. Let us see about 80CCC section. Section 80CCC of the Income Tax Act of 1961 provides deductions of up to 1.5 lakhs per annum for contributions made by an individual towards specified pension funds that are offered by a life insurance. The deduction is within the limit of Section 80C. The primary condition for availing this exemption is that the policy for which the money has been spent must be providing a pension or a periodical annuity. Section 80CCC is read along with Section 80C and Section 80CCD1, thereby limiting the total exemption limit to rupees 1,50,000 per annum. Let us see about the Section 80CCD. Section 80CCD relates to the deductions available to individuals against contributions made to the National Pension Scheme NPS or the Atal Pension Yojana APY, contributions made by the employers towards the MPS also come under this section. NPS is a notified pension scheme from the central government. Additional deduction of rupees 50,000 is allowed for amount deposited to NPS account, contributions to Atal Pension Yojana is also eligible for deduction. NPS will have a highest interest rate when compared to other FDs available. Let us see about the next section, 80D. 80D section is for everyone. Every individual can claim a deduction from their total income for medical insurance premiums paid in financial year under section 80D. This deduction is also available for top up health plans and critical illness plans. The deduction benefit is available not only for the health insurance plans for self but also for buying the policy to cover spouse or your dependent children or parent. The best part is that it is over and above the deduction claimed under 80C. That's a great news. So people invest in health insurance plans. The limit for Section 80D deduction is rupees 25,000 for premiums paid for self family, rupees 50,000 for premiums paid for senior citizen parents. Additionally, health checkups to the extent of rupees 5,000 are also allowed and covered within the overall limit. Deduction up to 50,000 with respect to the medical expenditure incurred by the senior citizen 60 years and above or towards the senior citizen parents, provided they are not covered under any Mediclaim policy. Salaried people in India can invest in many ways to save their tax, like PPF, EPF, health insurance, Mediclaim, pension schemes, post office schemes, 5 years FT plans, NSC, NPS, etc. etc. They can use the various investment tools to save their taxes. Taxes are very important for the central government and state government for development. Saving the tax and investing in the proper channel is very important for each and every salaried person in India. So, invest wisely. Let us go to the next section. Section 80DD. Section 80DD for disabled dependent. Expenditure incurred on medical treatment, including nursing, training, and rehabilitation of handicapped dependent relative. Payment or deposit to specific scheme for maintenance of handicapped dependent relative, where disability is 40% or more but less than 80%, fixed deduction of rupees 75,000. Where there is a severe disability more than 80%, fixed deduction of rupees 1,25,000. To claim this deduction, a certificate of disability is required from prescribed medical authority. This will come under 80DD. In the next section, we will see about 80U. 80U is a section where deduction for person suffering from physical disability. A deduction of rupees 75,000 is available to a resident individual who suffers from a physical disability including blindness or mental retardation. In case of severe disability, one can claim a deduction of rupees 1,25,000 rupees. Let us see about the next section, 80G. 80G is for everyone and every individual in India. It is related to donations. Deduction for donations towards social causes. Various donations specified under 80G are eligible for deduction up to either 100% or 50% with or without restriction. From financial year 2017 to 18, any donation made in cash exceeding rupees 2000 will not be allowed as deduction. The donation above rupees 2000 should be made in any mode other than cash to qualify for 80G. Donations eligible for 100% deduction under section 80G without qualifying limit. Various donations which are eligible for 100% deduction without qualifying limit. National Defence Fund set up by the central government, Prime Minister's National Relief Fund, National Foundation for Communal Harmony, a approved university or education institution of national eminence, Zilla Saskara Samsriti fund set up by a state government for the medical relief to the poor, National Illness Assistance Fund, National Blood Transfusion Council or to any state blood transfusion council, National Trust for Welfare of Persons with Autism, Cerebral Palsy, Mental Retardation and Multiple Disabilities, National Sports Fund, National Cultural Fund, Fund for Technology Development and Application, National Children's Fund, Chief Minister's Relief Fund or Lieutenant Governor's Relief Fund with respect to any state or union territory. The Army Central Welfare Fund or the Indian Naval Benefit Fund, the Maharashtra Chief Minister Relief Fund during October 1st, 1993 and October 6, 1993. Chief Minister's Earthquake Relief Fund, Maharashtra, any fund set up by the government of Gujarat exclusively for earthquakes in Gujarat. Like this, there are many more funds where we can donate and get benefited. Let us see about the donations eligible for 50% deduction under section 80G without qualifying limit. There are four funds and trusts where we can invest. Jawaharlal Nehru Memorial Fund, Prime Minister Drought Relief Fund, Indira Gandhi Memorial Trust, Rajiv Gandhi Foundation. Let us see about the next 80 GGC. Section 80 GGC, Contribution to Political Parties. Deduction on contributions given by any person to political parties. Deduction under this section allowed to an individual taxpayer for any amount contributed to a political party or an electoral trust. It is not available for companies, local authorities, and an individual judicial person, wholly or partially funded by the government. You can avail this deduction only if you pay any way of other than cash. Options to save income tax, which is a very important section of this video. There are many options to save income tax by an individual. Leave travel allowance LTA, employee contribution to provident fund EPF, standard deduction, professional tax, exemption of leave encashment, exemption under section 8G-1, exemption from the receipt upon opting for voluntary retirement, pension, gratuity, donations to political parties, meal coupons, car leased by employer, expenses related to internet or phone, medical insurance, home loan, education loan, mutual funds, deductions. Leave travel allowance depends upon the organization. EPF is applicable to all. Standard deduction is by the government, so it is applicable to all. Professional tax is applicable to all. Exemption of leave encashment, that is also by the government and applicable to all. Pension, it is for the people who invest in pension schemes. They will get good benefits and from the tax. Gratuity, those who spend more than 5 years in an organization, they will get the gratuity benefit. Donation to political parties, every individual can donate without any limit to the political parties and get 100% or 50% benefit. Meal coupons, some organizations arrange meal coupons to help their employees to avoid more taxes. Car leased by employer, this is a wonderful scheme followed by certain organizations in India to give tax benefit to their employees. Expenses related to internet or phone can also be used for getting benefit in income tax. These are the various ways each and every individual in India can invest and get benefited from tax. So invest rightly and save tax. Thank you so much. Subscribe my channel, like and share to your friends. Thank you.